Inflation does not just mean prices go up. It means the same money slowly buys less of life. The coffee, rent, school fees, fuel, groceries, and services around you may all become more expensive, but not always at the same speed. That is why inflation feels personal. It changes what your salary can do, what your savings are worth, and how confident people feel about the future. At its simplest, inflation is a broad rise in prices across an economy over time. One expensive product is not inflation by itself. If mangoes become costly because of a bad harvest, that is a price change. Inflation is when many prices across many areas rise enough that the purchasing power of money falls. It is not one price jumping. It is the general price level moving upward. The first mechanic is demand. If households, businesses, and governments all want to buy more than the economy can easily produce, sellers may raise prices. Imagine many families trying to buy homes in the same city while builders cannot add houses quickly. Buyers compete, bids rise, rents rise, and related costs may rise too. Too much spending chasing limited supply creates demand pull inflation. The second mechanic is cost. Businesses often raise prices when their own costs rise. If fuel becomes more expensive, delivery costs rise. If wheat becomes expensive, bread producers face pressure. If wages rise sharply in an industry, service prices may adjust. This is cost-push inflation. The company may not be greedily inventing a price increase. It may be passing along a higher cost of producing or delivering the product. A practical example is a bakery. If flour, electricity, rent, packaging, and delivery all become more expensive, the bakery has limited options. It can accept lower profit, reduce quality, shrink the product, or raise prices. If many businesses face the same pressure, customers begin seeing price increases everywhere. That is how cost pressure can spread from one input into daily life. Inflation can also come from money and credit growing faster than real output. If more money is available but the number of goods and services does not grow enough, prices can rise. This does not mean every increase in money automatically creates inflation. The important question is whether spending power grows faster than the economy's ability to supply what people want to buy. Central banks watch inflation closely because they influence interest rates and money conditions. When inflation is too high, a central bank may raise interest rates. Higher rates make borrowing more expensive for mortgages, car loans, business loans, and credit cards. That can slow spending and cool demand. But higher rates can also hurt borrowers and slow the economy, so the tool is powerful but not painless. Inflation is usually measured with price indexes. A price index tracks a basket of goods and services, such as food, housing, transport, healthcare, and other everyday costs. If the basket costs more this year than last year, the index rises. But your personal inflation may differ from the official number because your spending pattern is not the same as the national basket. For example, a young renter, a retired homeowner, and a family with school fees may feel inflation differently. If rent rises sharply, the renter may feel squeezed even if other prices are stable. If medicine rises, the retiree may feel it more. If food and tuition rise together, the family's budget changes quickly. Inflation is a national number, but the pain is personal. Inflation also changes wages. If prices rise but your income stays the same, your real income falls. You may earn the same salary on paper, but it buys less. If wages rise faster than prices, workers may feel better off. If wages rise slower than prices, people feel poorer even without a pay cut. This is why inflation can create frustration even when employment looks stable. Businesses experience inflation through planning uncertainty. A restaurant setting menu prices today may not know what ingredients will cost in 3 months. A builder may quote a project and later face higher steel or labor costs. A shop may need to reorder stock at higher prices than expected. When inflation becomes unpredictable, businesses spend more energy protecting themselves and less energy planning confidently. Savers are affected too. If your savings earn 2% interest but prices rise 6%, your money grows on paper while losing buying power. That difference is the real return. This is why people look for investments that can at least keep up with inflation. Cash is useful for safety and emergencies, but over long periods, inflation can quietly erode idle money. Borrowers can experience inflation differently. If someone has a fixed-rate loan and their income rises over time, inflation may make the old debt feel easier to repay. But if the loan has a variable rate, higher inflation may lead to higher interest rates and larger payments. So inflation can reduce the real burden of some old debts while making new or adjustable debt more expensive. Not all inflation is equally harmful. Low and stable inflation can be manageable because businesses and households can plan. Very high inflation is dangerous because money loses trust. People rush to spend before prices rise again. Sellers change prices constantly. Workers demand faster wage increases. Contracts become harder to set. The economy becomes less about producing value and more about escaping uncertainty. Deflation, the opposite of inflation, can also be risky. Falling prices sound good at first, but if people expect prices to keep falling, they may delay purchases. Businesses may earn less, cut wages, or reduce hiring. Debt becomes harder to repay because money becomes more valuable while income may weaken. The goal is not simply cheaper prices forever. The goal is stability. Inflation expectations matter because belief can influence behavior. If workers expect prices to rise, they may ask for higher wages. If businesses expect costs to rise, they may raise prices early. If consumers expect goods to become more expensive, they may buy sooner. Expectations can become part of the inflation process itself, even before every cost has actually changed. A common misunderstanding is thinking inflation means every price rises equally. It does not. Housing may rise while electronics fall. Food may jump while clothing stays flat. Some prices rise because of global supply shocks. Others rise because of local demand. Some products shrink in size instead of showing a clear price increase. Inflation is broad, but the details are uneven. For viewers, the practical takeaway is to watch your own basket. Track the costs that dominate your life: rent or mortgage, food, transport, insurance, school, healthcare, debt payments, and utilities. A headline inflation number may be useful, but your household budget tells you where the pressure actually is. Inflation management begins with knowing which prices are hitting you hardest. You can also protect yourself by reducing waste, avoiding high-interest debt, building an emergency buffer, comparing recurring bills, and thinking carefully before locking into large payments. Inflation punishes people who have no flexibility. The more fixed obligations you carry, the harder it is to adjust when prices rise. Flexibility becomes a financial defense. So inflation is not just an economic term. It is the story of money losing buying power as demand, costs, money conditions, expectations, and supply limits interact. It affects workers, savers, borrowers, businesses, governments, and households differently. Once you understand how inflation works, rising prices stop looking like random punishment and start looking like signals moving through the economy.